Boys, you never spend the principal, only the interest. That was Kevin O'Leary's mother's message as she clipped corporate bond coupons or pulled her sons to the bank to receive monthly dividend checks from the stocks she traded in. And it's sound guidance that still resonates today. On top of that, Kevin O'Leary has long searched out assets that will offer positive returns with less exposure to the broader economy to ensure the long-lived trust will have enough money to provide for future generations. So for today's video, let's find out why Kevin O'Leary is a fan of dividend stocks. But before we get into it, do me a favor and smash the like, subscribe to the channel, and hit the bell button for notifications whenever a new video is published. Get to know more with Kevin O'Leary. Kevin O'Leary, an investor, is very successful with a net worth of over $400 million. He's known for his appearance on the hit television show Shark Tank. Kevin, on the other hand, might not be aware that he loves dividend investment, and he sees as he created his exchange-traded fund, ETF, that invests in high-quality dividend-paying stocks. O'Leary, who spoke with Forbes right before the season premiere of Shark Tank, claims his whole investing strategy stems from his mother's teachings, who accumulated a stunning profitable investment fund that was hidden entirely until her passing. After she died, he evaluated the findings. He discovered that her cautious policy of purchasing corporate credit and dividend-paying securities had outperformed the broader markets and almost every other approach he might compare it to. When it comes to caring for his relatives, O'Leary, who earned his fortune selling the learning company to Mattel for $3 billion after the dot-com boom, is following in his mother's footsteps. O'Leary remains dedicated to caring for his family's children by schooling through a family trust, but as the money runs out, each child is left to build their wealth, as he puts it. Significance of cash flow. Let's have a look at Kevin's main points. First, when making an investment decision, consider cash flow. It makes sense because the only proper way to return money to owners is by positive cash flow. As Warren Buffett likes to point out, a stock is only a tiny part of a market. As a result, the rules that apply when purchasing a stock are the same as buying a whole company. You would make a profit to get a return on your investment. If you can't achieve positive cash flow as a business owner, you won't earn profits. The only other option is to offer the company to someone else at a higher price, expecting to either see a profit or sell it again. As Kevin points out, this is just a hypothesis. Finally, if the company has little way of producing cash flow, it has no benefit to long-term shareholders. Kevin uses this line of reasoning to promote dividend stock investing. A dividend is the only way for a shareholder to profit without selling any of their stock. He also cites that dividends, not capital appreciation, account for 71% of all equity returns. Furthermore, stability and diversification are essential factors for Kevin when it comes to his investments. It's for this purpose that he creates dividend exchange-traded funds, ETFs. Get to know more about OUSA. OUSA is a high-quality, low-volatility dividend ETF launched on July 14, 2015, to serve as a central holding in investors' portfolios. The AIM index has adjusted to the O-Shares U.S. Quality Dividend Index as of June 2020, but it also has a 5% single security limit weight. The fund is rebalanced every 3 months, reconstitutes every year at the end of September, and charges a 0.48% annual fee. On top of that, we'll have a glimpse at Kevin's U.S. dividend ETF, OUSA. Dividends, as Kevin said, comprise the majority of market returns. What is the reason for this? It has to do with the compound interest principle. Compound interest, according to Albert Einstein, is the strongest force in the world. The graph below illustrates this. The S&P 500 has returned more than 6,500% since 1957. The total return, including dividends and compounding, is more than 46,000%. It assumes that dividends and compounding account for roughly 80% of the hypothetical overall gain that the investor would have received. Even better, profitable dividend-paying companies can sustain and grow their dividends over time. For example, dividends per share earned by firms in S&P 500 have more than doubled from 2010 to 2019, with an annual growth pace of 11%. So let's have a peek at the firms that make up OUSA. Microsoft, Johnson & Johnson, Home Depot, Procter & Gamble, Merck & Company, Verizon, Pfizer, Apple, Cisco, Honeywell, United Health Company, Amgen, Coca-Cola, Lockheed Martin, PepsiCo, and 3M are among OUSA's top holdings as of December 2020. The ETF has 101 holdings in general, with a focus on high-quality, large-cap dividend-paying stocks. Healthcare accounts for 22% of the total, while computer technology accounts for 21%. Consumer staples have a 16.5% market share, while industrials have a 14.8% market share, and so on. Since its creation in July 2015, the fund has returned 52% at a price. All about the dividends. It also pays monthly dividends to shareholders that range in sum depending on the portfolio's dividend return that month. The most current per-share distributions are seen throughout. The annual dividend yield is usually 2.08%, which is modest, but better than benchmark indices such as S&P 500. OUSA requires a 0.4% cost level, which ensures you incur a 0.48% annual premium for the investments in the portfolio. It's used to cover the fund's administration fees, running costs, and all other expenses. It is one of the main reasons why we dislike ETFs and managed funds. And if the fund loses money or doesn't know more than you should have on your own, you lose a part of your savings to payments per year. In the long run, these payments can result in a significant reduction in total returns. We still prefer to have more leverage over our finances. You have little control over the investments made by these assets. For instance, in December 2019, OUSA had 9.3% of its portfolio in the energy market, with ExxonMobil accounting for 5% of the total, and Chevron accounting for 4% of the total. They sold out entirely in 2020 and now have a 0% energy concentration in their portfolio. We now understand that the industry was severely harmed in 2020 and its worth collapsed. Exxon and Chevron, for example, assumed they would recover in 2021 and beyond. They have solid balance sheets and have maintained their dividends through the worst year in oil history. OUSA could have reloaded at a cheaper cost per share, if any of that. What happened to ETFs? They had some pleasant perceptions towards these businesses at the start of 2020. ETFs have low risk level and are unable to accept short-term risks in exchange for long-term gains. It's because they would continue to provide value to their customers. If they take substantial short-term risks, their clients may withdraw, causing their portfolios to crash. It isn't aimed at OUSA specifically, but rather at ETFs in general. OUSA is a good dividend ETF in my opinion, and it's perfect for investors who want to start investing in dividends but don't want to do their homework or select stocks. And if you aren't involved in ETFs, studying dividend funds may be beneficial. You should look through their portfolios and get a sense of what they possess, which can serve as a decent starting point for your portfolio. Even though Kevin enjoys dividends and spends a large portion of his net worth in OUSA, he does violate his maxim of not buying in return on capital securities. The tricky thing was figuring out how to put certain principles to use. For example, while OLeary enjoyed ETFs, he discovered that the index they were based on were all market cap weighted, which meant that most funds might have way too much money invested in their most significant components. Kevin already has a second exchange-traded fund named OGIG. This article focuses on global internet beasts such as Amazon, Alibaba, Facebook, Alphabet, Microsoft, Shopify, and so on. This investment has returned 112% so far this year. Dividend investment isn't a religion you have to practice religiously, but it's an excellent addition to your investments and will help you create a flow of passive income. What do you think about the dividend? Is it worth investing in? Let me know your thoughts in the comment section down below. Before leaving, don't forget to like, subscribe, and hit the bell button for notifications on our future content. With that being said, see you in the next one.